Good morning. You're watching a live daily market outlook for Friday, 28th of October 2011, prepared by Windsor Brokers. As we witnessed yesterday's strong rallies in the market came as a result of long-awaited decision of Eurozone. Actually, the last minute decision of Eurozone steps in solving the current debt problem that sparked a heavy risk appetite and pushed the euro and sterling as well as commodities significantly higher. Actually, the euro reached a 7-week peak during the night session today after yesterday's rally. Through some significant barriers that we will take a look later on the technical part. The deal actually reached includes the agreement that private banks and insurers would accept 50% losses on their Greek debt holdings and leveraging the EU bailout fund and the recapitalization of its banks. It's unlikely that the agreement will solve all European financial problems, but clear signs of progress in this process, and as well backed by quite healthy yesterday's US third quarter GDP data, changed actually outlook, gave an additional boost to euro, and changed the dollar's outlook to bearish, as the dollar with its near zero interest rates guaranteed over the next 2 years is getting sold off in global optimism and risk appetite, as investors use it to fund their more risky assets trading. The dollar also fell against the yen, hit again the fresh low of 75.66, the marginal fresh record low yesterday, and even after the further monetary policy easing by Bank of Japan. However, this prompted the Japanese finance minister to again warn that he would take firm steps against yen's rise as needed. So mentioned in our previous session that pending intervention from Japanese central bank is still on the table and likely to occur if the things continue to move in this direction. Global optimism, as I said, pushed the euro. However, during the Asian session, we saw some consolidation in the markets after yesterday's strong rallies. But for euro, the sentiment remains quite optimistic, and the further gains are likely according to the number of world analysts. To support the current plan of the Eurozone, the head of European Bailout Fund, Klaus Regling, who is actually the chief executive of the EFSF, European Financial Stability Facility, traveled to China and had some meetings. However, he said that he doesn't expect to reach the conclusive deal with Chinese leaders during his current visit, but expects China as a surplus-rich country to continue to buy bonds issued by the fund, so some help will be seen. He is also traveling to Japan, as current agreement is just agreement on the paper. Now they are looking to find enough funds to back it and to make it workable. From today's calendar, the events already released. GfK consumer confidence from UK dropped to its lowest level since 2009, and the release is minus 32 versus minus 30 the previous one and the forecast. While from Japan, the Tokyo core CPI on the yearly basis came as expected, minus 0.4%. compared to previous release of minus 0.1%. and the national core CPI is as expected 0.2%. Unemployment in Japan dropped to 4.1% compared to the 4.3 previous release and the 4.5% forecast. Also, the industrial production in Japan dropped significantly to dropped by 4% versus the 2% drop forecasted, and a growth of 0.6% seen in the previous month. Still to come from Switzerland economic barometer due at 9:30 GMT. A slight decrease is expected in today's release at 1 compared to 1.21 the previous month release. And then from states, core PCI price index expected 0.1 unchanged from the previous release. Employment cost index quarterly 0.6% forecast versus 0.7% previous release. Personal spending expected to raise by 0.6% compared to previous one at 0.2%, and the personal income also in a more positive territory. 0.4% is today's consensus versus minus 0.1 previous release. University of Michigan consumer sentiment is due at 13:55 GMT, and the improvement to 58.1 is forecasted for today compared to the previous release at 57.5. Now let's take a look on the markets and see the past 24 hours movements. Starting with euro, as we can see on the daily chart, the euro rallied significantly yesterday after clearing 140 barrier, which is Fibonacci 61.8% of the downtrend from 145.48, clearing 90 and the most significant 200 days simple moving average, and extending gains to 142.46 so far. It's just ahead of the resistance level at 142.60 zone, which is the low of 19th of August and the high of 6th of September. That was the initial upside target. Getting short of these levels and taking some consolidative mode as the hourly studies reached extremely overbought levels. So we might see some consolidation and establishing the pair in the new levels reached yesterday, with the pullback seen down towards 141 initially, and then 140.40, and the key support at 139.55, which is the previous consolidation ceiling, above a reversal above which would keep the bullish sentiment intact for further gains. The prospect for euro looks quite bright at this point, as the daily studies are entering the positive area. However, approaching the overbought zone, so we might see some deeper correction preceding a fresh rally. It's important to say at this point that medium-term sentiment, if we take a look of the latest down move from 145.48, is turning more positive and opening prospect for a further rally of the pair, as long as 139.55, 139 zone holds the downside. Also, the trend line support at 139, currently 139.25, holds the upside intact. The British pound also extended gains yesterday, hitting a fresh high at 161.40, which is above 161, which is exactly the 200 days moving average on daily chart, and breaking above initial barrier at 61.8, Fibonacci retracement of 166.17 down to 152.71 down leg. At this point, the 200 days moving average caps the near-term structure, and some corrective pullback is likely at this point, as already our hourly and 4-hour studies are emerging out of the overbought zone, with the initial support at 160.40, and then we have 160, where is also the main bull trend line, currently standing at 159.72. However, the holding about 159.70 and 159, which is the strong support zone, keeps the positive outlook intact, and the further extension higher seen towards after break of 161.40 to look for 162 and 162 initially, and then possible extension up to 163, 163.50 on a break. Dollar yen is holding its short-term negative tone with a series of marginal fresh record lows. The latest one posted at 75.65 in the early hours of American session yesterday, as the upside remains firmly capped just above 76 barrier, 76.25, 76.50 are initial resistance at this point. Corrective bounce on break of 76.50 faces the strong barrier at 76 currently the main bear trend line. Unless intervention occurs, that might boost the pair for approximately 300 points higher minimum. The outlook remains firmly bearish, and the previously mentioned the barriers are expected to limit the upside for now, with 75 level in focus in the short term for dollar yen. The dollar Swiss, as global dollar weakness continues to persist, and especially current risk appetite push the greenback lower. It's extended losses through our strong support at 87.50, where was the 200 days pardon, moving average, and clearing also the initial support at 86.46, the 15th of September low, to extend so far to 85.66, and just ahead of 50% Fibonacci retracement at 85.13. 85.10.20 is the strong support zone. Fibonacci and the previous highs of July and June, we have it between 85.50 and 85.20. Pardon. Along with the 50% Fibonacci retracement expected for now to offer a good support. However, the sentiment on the medium term is turning negative, as the daily MACD is breaking below their midline, and the momentum is already lower. So we might see further extension towards the initial area at 85.50, 85.20, and then we have 84.09, the 90 days moving average on the daily chart. On the upside, the immediate barrier comes at 87.30 zone, while 88.60, 88.80, the previous stronger resistance, are expected to cap the upside for now. Regarding commodities, gold has registered strong gains yesterday, clearing 50% after break of 1700, 1695, 1700, our initial barrier, extending gains through 50% Fibonacci retracement at 1725, the retracement of 1920, 1532 down move, also briefly breaking above daily 55 days moving average, keeping the focus on the upside. Regaining strong momentum on the daily chart keeps focus still at the upside, with the MACD still below the midline, but pointing higher and approaching actually the currently trading at the midline, looking for a further extension higher. Immediate barriers on the upside at 1760 and 61.8% Fibonacci retracement at 1770 are in focus now, with the corrective pullbacks on already overbought near-term studies facing initial support at 1727 and 1706, while previous consolidation range and 38.2% retracement at 1695, 1700 is expected to contain the dips in order to keep the bulls in play and intact. Loss of 1700, 1695 would delay current rally and open way for stronger pullback. However, only loss of 1600 support would turn the outlook again negative. The crude oil gets slightly congested, just under 200 days moving average and 50% Fibonacci retracement of the broader downtrend from 114.80 down to 74.94 at close to 95 zone, as the recent gains were capped at 94.50, and the corrective pullback found support at 90 level, however still unable to break higher. Further correction is not ruled out, as the 4-hour studies are losing momentum, and the pullback down to 90 zone, which is strong support. 90, 89, 66 is likely in the short term. However, only loss of 84, 20, 83, 40 is going to turn the outlook bearish. Until then, corrective pullbacks above 90 are to keep the immediate focus higher, and possible extension through this strong resistance zone, 200 days moving average and the Fibonacci level, to open 100 barrier, psychological barrier of 100 dollars per barrel, and the previous high of 26th of July at 100.60.